Been a tough year being a property investor? Rising interest rates got you second guessing? Not sure who to turn to for help? You need to reach out to Australian Property Scout, one of Smart Property Investment's most trusted buyers agency. Director Sam Gordon has personally helped many SPI show listeners invest to reach their financial goals using his purpose-built strategies. So what are you waiting for? Head to www.australianpropertyscout.com.au and book in a call with us today.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, welcome back. Thanks for tuning in. My name's Alex Whitlock. I'm standing in for Phil Tarrant, who is down in Canberra at the moment. So I've got a chance to have a catch up with an investor whose story is very, very interesting. We'll get into that in a minute. Interesting time at the moment. We're in the spring selling season. We're in a fairly precarious period of time in terms of where the market's at. Looking at the data over the last few months, you know, the CoreLogic data shows that auction clearance rates they're kind of starting to sort of pick up a little bit now, getting above the 60%. Auction volumes are picking up, but there's clearly a lot of uncertainty around, you know, in terms of where the market's going. Many markets still just sort of tailing off. We're in a market, I guess, which is not really a seller's market, not really a buyer's market, bit of an equilibrium. Certainly some good bargains out there, but definitely getting a market that's quite challenging to fund. But there's always opportunity. I mean, there's opportunity in any market, a rising market, a flat market, you know, and certainly in a declining market. So I'm sure many of you are thinking about your first foray into real estate, maybe planning on gearing up for the new year, maybe looking to pick up a bargain as we get towards the Christmas period. But certainly a very, very interesting time. For me, I always think about sort of breaking into the property market and when is the right time. You know, I think it's a challenge, certainly for younger buyers to get into the market. I know a lot of people feel the market is against them, but, you know, you do see younger buyers who manage to get a deposit together by one means or another, whether it's through, you know, sort of scraping together, you know, the bucks as they work, or whether it's maybe some help from somebody, you know, in the family or maybe a friend. But I think there's always people who are looking to get into that market. The question is, when is the right time to get in? Look, over the course of this show, I'm going to hopefully give you a bit of an insight into a young man who has been very, very focused on property. It's not his only passion in life, but sort of property is something that he has been very driven to being successful in and is doing pretty well at the moment as far as I can see. This gentleman's called Tim Brown. He's taken time to come up from Melbourne to join me, and he's going to tell me about his journey, tell me about his passions, talk about his life. Maybe we'll get a bit of insight into where he's going to invest into the future. Tim, welcome to the show.
Thanks so much, Alex. Appreciate you having me on.
Good of you to come up from Melbourne. It's a bit of a hike.
Yeah, we thought we haven't travelled in a while, so we'd get up here and see sunny Sydney from wet Melbourne at the moment.
Yeah, it's not too bad at the moment. Yeah, we've got something of a spring here for once. It's a bit of a contrast to this time last year where it did nothing but rain, but it's nice at the moment.
Yeah, it's beautiful.
What's your thoughts? We'll talk about your background in a moment, but you know, you've got 7 properties in your portfolio, so you've got a bit of experience. You're a young man, you're 30 years old at the moment. How are you seeing the marketplace at the moment as we get into this sort of the tail end of this spring season?
Yeah, I think there's a lot of fear out there and people are quite skeptical about everything that's going on, but I'm really seeing the astute investors and the ambitious starting to really push into the market, really seeing those opportunities open up and then jumping in. And I think it's slowly changing that sentiment. And I really think it's a great time to start getting in. I think it will change on a dime. Like people, their emotions take over. And when the sentiment changes, it's all on. So I think the people who are jumping in now and preparing for that position, they're going to do really well.
The funny thing is in the marketplace, the media has a bigger relationship with property. And it's not a love-hate relationship. It's a love relationship. Now, when things aren't going so well, the media, it's all doom and gloom and prices are falling and interest rates are going up and it's there's blood on the streets, or it's, you know, kind of the sun shining and things are rocketing up. But one way or the other, the media has a relationship with property. And for investors, this has an impact. What are your observations at the moment? What are you picking up from the media in terms of where, you know, you think the market is?
Yeah, I think it's very dangerous to listen to the media in terms of your investment decisions, because if you're investing, you should be looking out at that long term. And especially if you're young, say if you're my age, you got a lot of life left. So you should be thinking that long-term goal instead of working on the market the media cycles, basically like that. But I think I'm seeing some articles pop up now in the media that are suggesting there's going to be some changes, particularly with the rate pause. You saw even just any of the equity markets boom the next day after the RBA decide to just pause the rates or even go 0.25 instead of the full 0.5. So it's interesting to see how quickly it does change. But yeah, the media definitely has a big influence on people, which is, I don't think, the best thing.
It's so funny because, it will swing, it will go, there's always a bit of a lag in data that comes out. So you can end up looking at things that have happened 2, 3, 4 months ago, and it can give a bit of a false impression about what's actually happening on the ground at the moment. What do you do to keep your finger on the pulse in terms of where to invest right now and not get caught up with data that's sort of out of date?
Yeah, it's a good question. I basically just ignore that short-term hysteria. I just ignore it and analyze my position, where do I want to be going, and how can I get there? And it's when my cash flows allow me to buy. If the property is the right one for me, I'll be buying it. It's a business decision. So it's just about analyzing your own goals and your own position, and again, looking out to that long term and just ignore the noise. Because, most people aren't investing and doing well for themselves. So if you're listening to most of those people, you'll get most of those results. So you got to listen to the few who are doing it.
So you're a young bloke, 30 years old. As many people feel that, the average age of the first home buyer is into their 30s, and here you are at 30. But you're not just beginning now. You're already well underway. You've got 7 properties in your portfolio. But look, it'd be good to get a bit of an insight into yourself, into your early years and sort of what took you into property. But tell me about your journey from school. What were your sort of passions and ambitions when you were a young bloke looking to leave school?
Yeah, as far as I can remember, I always wanted to join the military. And that's exactly what I did. So, going through school, as most other military members, didn't love it. Didn't love school, was a bit naughty, wasn't always present physically. So to get out of school and then move into the army was just the goal. And that's all I cared about at that time. So it was pretty much just waiting until I had the opportunity to be able to do that. I enjoyed my younger years. I enjoyed school for the social aspects. But beyond that, I was just ready to jump in the military and serve.
Did you have any friends or family who'd also served? Was there anyone that was sort of a guiding light in terms of where that was going to take you?
My grandpa served, and he was in the reserves for as long as I can remember. And that influenced a bit, but I think I just always had this innate, keen sense of service, and I just loved Australia, and I was just proud and just wanted to go and do my bit. And I just loved the discipline and the fitness and the regimented side of it all. And that was just me. I just wanted to jump in.
Oh, that's a big thing. And what age were you when you signed up?
Well, I was 22 when I finally got in. I was adamant on a specific role as a cavalryman, and they were hard to get at that time. So straight out of school, I tried to get in. They said, go away and get some life experience. So I did a bit of traveling. And when I came back, tried again, and they said, all right, we'll have you. But it did take a bit of time to secure that role. There's a few other opportunities, different positions to move into, but I wanted to be in light armoured vehicles, cruising around, shooting big guns in the battlefield, and that's the role I wanted. So I waited. I was patient to get into that. So 22.
Very impressive, and full credit to you. So you joined the military. You got in at 22 years old. Where does the story in terms of your focus around property come into this? Was it sort of prior to this, or was it during your service?
It was during the service. So I'm very goal orientated, and I was obsessed with getting into the army, and that's all I can really consciously remember me caring about. So once I got into the army, I felt a bit lost in a way. I was like, well, what do I care about now? Like, obviously there was that army that I currently cared about, but I needed something else to obsess over, something to drive for. And I knew I was going to be the army forever, and I was on a capped wage, government wage. As I said, you can be the best soldier ever, but your wage stays the same. So I thought, well, I don't want to work forever, so I need to do something different. So I started studying and looking what everyone else was doing, and how can I get into something different? And that's how I kind of landed on property. And then every waking spare minute I had, I was just learning about it, learning, studying, reading every book, watching YouTube videos, whatever it was. I was just obsessed. Was there, again, with property, was there anyone that you were serving with that also bought? Was there any talk, amongst fellow soldiers around investment in property? What were the sort of the driving force? What was the main thing that kind of like penetrated you and sort of brought you in that direction? Not that I remember. Maybe I was naive. There was probably people doing it without me knowing, but I definitely kept my ambitions really quiet, because one thing I did learn from reading other people is that when you're trying to do something like that is perceived to be risky, your circle of influence and the outer circle become very critical of what you're doing. And all of a sudden, it can be very difficult to navigate having a circle of influence, family and friends who are saying, oh, shouldn't do this, a bit risky and stuff. And I didn't want to hear it. I knew what I wanted, so I just kept it very quiet, under wraps, and just did my own thing, trying to succeed silently, basically. But I definitely had a few people on the outside, my cousin and his family and some other friends that were doing it. So I leveraged off them a lot. So I definitely from the start, I leveraged off people who were already doing it. And that was like a bit of a key for me, like not listening to, as the classic here, the taxi driver, the uncle at the barbecue, all that stuff. It was people who were in the space already.
Yeah, it's funny. It's a fair bit of hot air around property. We all hear the big stories and we can see you watch, your Lux listings and that type of show and you see the big numbers. But, so you can kind of be a bit cynical about some of the profits that people make or purport to make, but there's an underlying sense that property works. You can look at the data around Australian property. It's not hard to work out, whether you look back over the data nationally or maybe look in your suburb to see the growth that's happened over any sort of 10 to 15 year period. So we know that there is that growth there. And I think for many of us, certainly for us here and for everyone listening in, there is that sort of trigger that that there is good money to be made in property with the right discipline and with the right focus. The challenge, of course, for all of us, for everyone who starts out, it's getting that initial deposit. So you're serving, I'm going to imagine you weren't on a massive wage in the army. Tell me about how you managed to get that first deposit together.
Yeah, so that's key. I wasn't on a massive wage. I think it was pretty average, about 75 grand, what most soldiers were being paid. And so that was the first hurdle. Like, how do I build a deposit? Because it was very difficult. So all I did was applied what I already knew and what I did in my profession, discipline. And so I organised my money. I started getting clever with my money, just not spending it on everything, because a lot of young soldiers, and I did myself, they get a nice wage straight out of high school and you drink a lot of that income. So I started organising my money, capturing all that surplus cash flow, putting it aside, put some gold dates for building that deposit. And I just stuck to it, just absolutely was disciplined and stuck to that goal date, hit that date, and then I had my deposit and I just deployed it.
So how did you come to that deposit figure? Did you look at the particular market that you were looking to buy? Where was it you were looking to buy, incidentally?
So that part wasn't even in my brain yet. It was about, okay, I just need to focus on this
So you had a dollar target. So what was your dollar target for a deposit before you actually started going out and looking at
it was about $60,000.
Okay.
Yeah, so this is about in 2016, 17 when I created this. So that was still like a deposit you could get into. I was trying to find the balance between having a mega deposit and then waiting too long and having a deposit that I could get into, whether that was at a higher LVR or whatever. I just knew that was probably a figure that I could start doing something.
60 grand going back to 2000. And look, you know what? You can still do damage with $60,000 now, but certainly going back, 7-8 years ago, that's giving you a reasonable war chest. It gives you flexibility in many markets, depending on what sort of asset you're looking to buy. There's enough for a deposit, and depending on what LVR, if you're going to go 10%, it gives you, a reasonable purchasing power. If you're going to go 20%, you're avoiding paying lenders' mortgage insurance. There's, a little bit of coverage for stamp duty. So, yeah, that's a reasonable target. How long did it take you to save that figure up?
It took about 3 years, to be honest. I had a partner then, obviously, and still do. So she was studying at university. So we're kind of on that in between that one income or a university student's income. So working sporadically. So it was quite difficult, but I think where we succeeded was really being disciplined again, as I said, with that money management and making sure we're putting aside that surplus cash flow as a priority over a massive lifestyle spend. So that's where we got that.
I really like what you're saying. I'd like to sort of just look a little bit deeper into it. Discipline's obviously a very key thing for you. You're clearly somebody who understands that. But discipline, for the sake of discipline, hasn't got a purpose. You're disciplined because you're looking towards getting to a goal. So it's having that focus of the end result that then empowers you to have that discipline. That's a big thing for a young guy and a partner who's at university. Tell me about, how you and your partner, how did you manage to come to that sort of that goal and that figure? And then what sort of things did you do in terms of your discipline? Tell me some of the things that motivated you to save that money on the way through.
Yeah, it's a great question. And I'm really big on this. It's understanding your why, because it can be very superficial when you're thinking about, I just want to invest in property because that's what people do. But you've got to remember that the property is just a vehicle to get you to somewhere. And the why is why you're doing it. And that sets the foundation of motivation, basically. But you can't work on motivation because it wanes. You got to work on discipline. So you got to attach all those three things together, and then that's when you can see your goals clearly. And once you understand that why, where I want to go, because obviously the why might be like, I don't want to work all my life. I want to have a nice income. I want to be able to go on holidays. Once you have that emotional connection to that, then the obstacles become really easy to get over. So then all of a sudden that discipline becomes habitual and becomes easy in a way, because like a muscle. As you train it more, you're going to be better at it.
And the obstacles are, first and foremost, doing without. Like you say, yourself, young man serving, your buddies are going out for a few beers.
Yeah.
You're not doing that as much, or, maybe a couple, but, and your partner equally, young as well, going without. And that's really where the discipline and being goal focused helps get you through those obstacles. And then you've got to keep going with it, right? Because, $60,000 over a 3-year period, look, let's say for the sake of argument, is $20,000 a year. That's a long time to do without and to make sacrifices to get to where you're going.
Yeah, exactly. But I think we try to not see it as a sacrifice. Like the way I use that word is, coming from military and having a keen interest in military history, there's blokes out there that sacrifice, not me. So in terms of sacrificing, I don't like to think I did any sacrificing. What I did is just manage my time and energy, my money better. So I'm going to compromise on buying this item or these new shoes or these new clothes, and I'm going to put that towards the deposit because I know what that's going to do for me in the end. So it's just about having that management, and I don't think it needs to be so strict where you can't do anything, you don't enjoy your lifestyle, because if you don't enjoy it, then you're not going to have sustainability in that, and that's with anything. So you got to have your fun money, as we call it, money that you can just do whatever you want with, but it's also the goal just needs to be to keep maintaining, capturing that surplus cash for that bigger end deposit goal.
I love the way you frame that. You've not sort of told a story of hardship and suffering and doing without. You've worked hard with your partner. You've followed a plan. You've enjoyed your life throughout those 3 years. It just goes to show, and not on a huge salary. It's just goes to show with a focus and with a goal and with an aim and with sort of a roadmap to get you there, exactly what's achievable. So, you've got your $60,000. At what point during that process of saving your deposit did you start thinking about what sort of asset you're going to invest in?
Yeah, so once I was close, I actually engaged my cousin who had a nice portfolio himself, and he understood the game, I guess I could call it. And he was saying he suggested using a buyer's agent because these guys are in the space, and it literally just saves you the time and energy to then now start researching all the different properties and stuff. And I was already, because I was learning so much, I was already happy to be borderless investor and business decision and not buy house and land packages and all those kind of key astute investor principles. So I engaged a buyer's agent and just outsourced that knowledge, basically.
I'm going to stop you there, Tim. We'll take a quick break. We're back in a couple of seconds. Welcome back. Great to have you with us again. So, Tim, you've got a buyer's agent. You've looked around. Tell us about, sort of how you made the step towards your first purchase.
Yeah, so basically the buyer's agent ran us through what needs to happen or how you can then utilize that deposit to get into an asset, and opened me up to not having to buy a big piece of land with a huge deposit. There are other opportunities out there for people with a smaller deposit, such as townhouses or villas and whatnot, because, it's the apartment kind of space can be dirty in investing. But I think what was clear to me at the end was types of investments in apartments and stuff were not as good as others. So getting those low to small density unit blocks and stuff were actually okay investments for people who could afford them and not a bigger house package. So that's what he guided me on, which was a really good move for us. Okay.
And did he source and find the first investment for you, or did you go and look in the marketplace yourself? And whereabouts were you looking to buy at this stage?
So pretty much I just handed over the trust to the buyer's agent, and then he sourced and found the first few properties for us. So yeah, he was integral to the rest of the portfolio building.
How many did you look at before you bought?
Maybe one or two, but again, I was pretty clear on outsourcing that knowledge. So I had trust in the buyer's agent that he knew what he was doing. I ran my own numbers on that, and obviously I asked my trusted circle of influence around me of what do you think of those who had done it? And they said, yeah, it's a no-brainer. It's a business decision. The numbers stack up, just buy it. It doesn't have to be the perfect first property. Like you just got to take action, decisive action, jump in and move on.
So what was the price of the first purchase?
$290,000.
And do you remember what interest rate you were looking at for your first loan?
Well, that's a good question. I think it was when the rates were starting to really come down.
Yeah.
I think it was about 2020. So the money was cheap then, and I believe it was around the 3.7, maybe even 4%.
Okay, so not too bad.
Yeah.
And what sort of LVR did you go for? How much of your 60, did you use all 60,000 for this purchase, or did you manage to hold some back?
We used most of it. We went for an 80% LVR because the goal was to try and extract equity as soon as we had the opportunity to then deploy it into another asset and keep growing the portfolio.
So you bought this asset. This was in South Australia, is that correct?
No, so that one was already, sorry, I've got to step back. So we purchased our own house and land package first to live in. That was an owner-occupier.
Okay.
And that was prior to the 60,000 deposit. We used a whole bunch of, the first homeowners, all those incentives.
Okay, yeah.
Sorry, I may have skipped that. So we bought that ourselves and that was being built. And then concurrently we're buying this first investment as well.
So there's another layer to this because I knew that you'd bought your own home. So not only are you looking to invest, you've also got the responsibility of taking on a mortgage. You've used every tool available to you and your partner with First Home Owners Grant. You're serving, so you've bought your own place. So not only are you looking to make your step into the investment market by saving hard whilst you're, sort of looking to buy your own home, you've got this underway already.
Yeah, basically. And yeah, that was a lot of incentives from the government and also Army that we were able to get into our own home. But I didn't consider that investment, obviously. I was first kind of, okay, where do we need to go from here? And then as I was going through all the process, I realized, okay, maybe buying established would have been better for us here to leverage out of this owner-occupier house to be an investment as well, because we knew we weren't going to be posted to that location forever.
Yep.
So I could have done that better. However, I did perform very well anyway. But yeah, the main kind of investment journey, which is where I led the story then, was getting that first place in New South Wales.
Okay. Tell me whereabouts. What was the suburb in New South Wales you bought?
It was actually in Mount Druitt.
Okay.
Yeah.
So you've, if you're familiar with the show and with my business partner, Phil Tarrant, who is the usual host here, we have our own portfolio, which we joint invested in. It's been covered many, many times on the show. Phil's a lot closer to it than I am, but we've got a couple of properties in Mount Druitt in our particular portfolio. We bought at an earlier cycle. So we were buying in 2012. This was sort of a few years on. $290,000, good price for that area. What exactly was it you bought there?
Yeah, we bought a 2-bed villa in a small complex. And that was, $290 was already, we went in under market straight away on that one, which is really good. So we pretty much had inbuilt equity straight away.
What do you reckon the true value of the property was at the time?
It was probably around the 320.
Okay.
Yeah. So that was good to get in because a few recent sales of the other units had gone for around that. So the 290 price was healthy to get in, which obviously shaped the decision to purchase this as well to scale the portfolio and cash flow positive as well.
And was this an off-market property? Was it being advertised? What was the backstory to this?
I actually don't recall whether this was off-market. I don't believe it was. The buyer's agent just knew that this was a good deal to jump into and obviously with his knowledge saw that Mount Druitt, Western Sydney was going to have a bit more of a boom over over the next few years as well, which is exactly what it did. Was
it a vacant property or was it tenanted at the time?
Vacant.
Vacant, okay. So you've found your property, you've through using a buyer's agent, you've managed to get it at below market value, which is great. You're a head start already. You're looking at sort of immediately, sort of a $20,000, maybe $30,000 start in terms of the value. Did you need to do any work on this or was it ready to go and ready to rent?
Ready to go, ready to rent. It's a bit dated inside, so it's got, the potential to do a bit of cosmetic updating down the track, but it was definitely livable as it was. So just pretty much got a tenant in there straight away.
When you were looking to purchase this first asset, what were you hoping and what were you thinking the rental value should be on this?
It was pretty much on par with the appraisal, which was around the 300, 310 mark per week.
See, that's a pretty good yield for a 290 purchase, going straight in and getting a 310 rental. Very, very good. A lot harder to do that at the moment in many, many markets, because we've seen very large growth every market's come off over the last sort of 8 to 12 months, but nonetheless, most markets are still seeing that the effect of a large growth. Rents are catching up now, but that's a very, very nice rental. Okay, so you've got that. You've got your principal place of residence. Life's good.
Yeah.
You're going good. Why didn't you just stay with the one property, with the one investment? What was it that sort of moved you on to go and look at your next one?
The goals to build out a portfolio that can sustain the lifestyle that I wanted to live and also create that intergenerational wealth to pass on to my friends and family and to hit those targets that I wanted to achieve. So it was just a very start and I still feel like I'm just starting right now even.
So you've got this, okay, so you bought your 2-bed villa in Mount Druitt. You've got your principal place of residence. At what point did you start preparing for the next purchase? And this you may already have been preparing for it before you bought this, or just give us, just give a bit of an insight into how you're starting to schedule your move into building a portfolio.
Yeah, well, always thinking ahead, basically, and working with the buyer's agent. That's why we went with the 80% LVR, so we were able to extract that instant equity that we had as well to push it into another asset. And that's why the finance structure is so important, because obviously property investing is a game of finance. You just got to get that lending to be able to move forward. So we were already looking at the next property as soon as we could, basically to get a reval straight away, pull that money out, and then find another asset.
Oh, so you got straight. How quick did you get another val on this?
I reckon it was only 4 or 5 months down the track.
Yeah, and you got a higher valuation?
Yeah, 100%. I can't remember exactly what it was, but we extracted
nonetheless,
like another 30, 40, 50 grand, maybe even out of it. Yeah.
This is the thing with, it's one of the very, very oldest adages, but it still stands true, is you make your money when you purchase. And it's really critical. I think often in a rising market, buyers can get a bit blasé and think, I won't worry, it's going up in value. But this really, really is a case in point where, when you buy below market value, where you buy well, it gives you access to that equity and, sort of enhance it. And if the property goes up in a rising market, hey, you've got even more. So you've got another val, you're able to release some equity. What was your next purchase?
Yeah, no, I definitely agree. You've got to be able to move forward straight away. So we just extracted straight away. And we ended up putting that money straight into a property in Labrador on the Gold Coast.
Okay.
Another unit as well. Because the cash I was pulling out was excellent, but it wasn't huge amounts of cash where I could push into bigger land holdings in other areas. We were just trying to scale for what my cash flows were. Because basically, as much as we can pull equity out, you got to be able to service the debt for the next purchase as well.
Yeah.
So being on that one income and having, my partner Georgie on and off different incomes as well was difficult. So we had to manage that finance to be able to purchase. So that was the one that our cash flow allowed us to purchase, and that did really well as well.
So let's just bring things back for everyone tuning in. So you're in the army, you've bought your principal place of residence, you've gone out, you've bought your first investment, you've bought extremely well, you're looking to buy, or you're just in the process of buying now your unit in the Gold Coast. Are you still in the army at this stage?
Yes, I am.
Yep. Okay. So you're obviously managing your money extremely well. Still, that discipline is still there. I would imagine you're on a slightly higher wage than when you first joined, but you're still not going to be sort of on major money. So you're obviously running your finances very tightly. What sort of things were you needing to do? Were you still saving as well, or were you really now looking to leverage off equity in your portfolio?
Yeah, very much both. So my wage wasn't that much better. It kind of only went up with the 2 to 3% increases that we were entitled to each year, which is basically just matching inflation. So it wasn't anything new to work with. So we were just making sure we actually became more disciplined because we knew, okay, we can do this. It was proof to us, okay, we can do this. So we got more disciplined with our money even, and we were saving what we could as well as extracting the equity and utilizing both of them, trying to put them together to build up the deposits and just keep deploying. So, and then this stage, Georgie was probably starting to look into more full-time employment, which was just a massive help for the servicing as well. So that was excellent.
So tell me about the purchase in the Gold Coast. It's another unit. How much was the purchase price for that one?
That was 190 grand.
On 90K.
Which is cheap.
Yeah, it was cheap.
Mm-hmm.
Yeah, it'd be nice buying something like that nowadays.
Oh, hard to find.
So just give us a little bit of an insight into the cash that you put in that. So you'd refinanced your unit in Mount Druitt. Did you refinance your principal place as well? Or were you just sticking to keeping it with your portfolio?
Just a portfolio. We just piggybacked off that. I haven't refinanced out of my principal place once at all. Even now, it's an investment property now, and I still haven't touched it. So
okay,
yeah, and that's done very, very well as well.
Tell me about the LVR for the 190K purchase.
Yeah, again, 80%. Yeah.
80%.
Yeah,
okay.
we pretty much went 80% whenever we could because it allowed us to be flexible with that lending. And the great thing was at this time, as we were refinancing and getting new loans, the rates were still coming down as well. So the cash flows were really matching up as well. So getting good rental yields was allowing us to continue to service and not have too much, have no money out of our lifestyle to hold these assets.
Was this a 1 or a 2-bed unit?
2-bed.
2-bed, okay. And what rental did you get on that?
At the start, it was already tenanted and it was under rental. I believe it was about $280, which is good for the purchase price, but right now it's $365 or something. So it was very much under rented. So I think that's what gave the buyer's agent a bit of negotiation power as well to be able to get such a good purchase price.
Did you keep the same agency that was renting that out, or did you change agents? Did you go to them and say, look, this rental's too low, can you go get some more? Or what was the process there?
Yeah, we changed. I'm a massive advocate for good property managers.
As are we.
Just don't, cheap is nothing. I'd rather pay double for a good management, because when it goes wrong, it's terrible time and you've got to have people in your corner. So I went and got good managers that I knew of, and they took over it. And then we obviously incrementally got the market rental back up to where it should be.
I'm going to just change tack a little bit. I know that you're no longer serving with the Army. Give us a snapshot as to when you left the Army and where your portfolio was at that particular time. And I'd also be interested to know if and how that changed your strategy.
Yeah, I left in mid-2020 and moved to another federal government agency. So again, it's capped wage again. So there was no real change in terms of the income coming in.
So similar income, that didn't change, yeah?
Pretty much similar. I negotiated going the same wage, so I didn't lose any money. And the portfolio was, I think I was at 6 properties then.
Okay.
Or maybe even 5. But yeah, I was pretty much, I had purchased quite a few more by that time.
You got your system and your discipline, and it was flowing nicely.
Yeah.
So although your role had changed, your income was stable, so it didn't put any kind of a spanner in the works. Did it change your outlook and your approach? You changed your roles, but were there any changes in terms of your sort of expectation and goals in terms of your property investment journey?
It did actually, yeah, but it probably made me more aggressive in terms of like building out the portfolio because Army was such a passion of mine. Now that I wasn't in it, I wasn't getting that itch scratched being in defense anymore. So I thought, okay, I really need to work on my portfolio so that can fund my life and I can get out of the 9-to-5 system that we live in. So that kind of actually put fuel on that fire, if anything.
So you've gone from, you got your Mount Druitt place, you got your Gold Coast place. Just quickly give us an overview of the next stepping stones, that point where you left the Army. Just give us a quick run through the properties that you purchased, and then we'll talk about where you're on now.
Yeah, so I think the next one was a property in Townsville, another 2-bed unit, and then one in Mackay, another unit as well. So obviously, as I said before, the cash flow wasn't massive to be able to purchase big properties. So just the units were really working well for me, really good positive cash flow out of them so I could scale and continue to go and build a bit of passive income. So, and then, there was a couple more after that one.
So did you stick with units? There seems to be a sort of a bit of a pattern around the townhouse unit type of approach. Have you changed that since now your portfolio is starting to grow, or are you still on the same track?
It's to change now, basically. So I want to start, that's kind of set the foundation of my portfolio. So now I want to move into some higher quality assets, dare I say. Yeah.
We'll hold you there for a second. Let's take a quick break. Let's find out what that is when we come back.
Want to slash thousands off your home loan repayments? Whether you're an investor or homeowner, we know how important it is to find the lender that suits your unique situation and with the best rate. If you've not compared your home or investment loan in the last 12 months, you may be able to cut your repayments today with a different lender. That could mean more money in your bank account and less stress when it comes to paying your loan. Find out why more borrowers are turning to Finny to refinance their home loans. Call us now on 1300 002 023 and find out what you could save, or visit our website finny.com.au to book an appointment.
Welcome back. We're with Tim Brown here. It's taking us through his journey, building a property portfolio. He's got 7 properties in his portfolio at the moment. The man's just 30 years old. He's shown incredible discipline, passion, vision for his portfolio. He's built his first 5 properties outside of his own home, sort of in and around units. He's bought extremely well. He's bought below market value. He's looked at value in terms of cash flow from getting good tenants in, but there's now a change of tack. Okay, so you've got your bedrock of good investments. How does the vision change, and what's the strategy now in terms of continuing your next advancement through your portfolio growth?
Yeah, so I reached 7 properties before I started wanting to change that tack majorly. So at this stage, end of 2020, I moved from Adelaide, where I was posted with the Army, to start the new employment in Melbourne. So then the Adelaide property is now becoming an investment.
Yeah.
And then I have the Mackay, Townsville, and then I purchased one in Brisbane, in Ogra. And then because I had about 6 properties and a decent foundation, I actually played a bit of a risk play for the next one. And I purchased in South Headland, which is obviously a big no-no for investing in mining towns. And obviously, if that's your first investment, I would definitely steer away from it.
What took you there? How did that come up in your strategy?
Well, the buyer's agent spoke to me and said, hey, look, you've got this bunch of properties. They're doing well. This is one that's extremely cheap, that He's got amazing cash flow.
What's cheap? Tell me what cheap is.
80K.
80K?
80K.
That's cheap.
Renting at $550 a week.
That's very good.
It's crazy.
That's an investor's dream.
It's insane. But obviously, you get those type of properties in those towns for a reason. So, but 80K was at the bottom of the market really, that I'm realizing now because it's picking up. It's pretty much doubled in 2 years. So that's something that I probably won't hold long term. That's a bit more of a plug and then pull out of and, use a bit of it, of that money somewhere else.
So it gives a bit of an idea as to what the actual property is. What was the land size? How many bedrooms? Just gives a bit of an overview of what it was.
Yeah, it's a 3-bed, 1-bath. Again, another villa. And that was in South Hedland and just phenomenal yields. So
that is a phenomenal yield, let me tell you.
Yeah, it's crazy. And that was really, really cool. So that was the last one we purchased. And then the tack now was to start building out high quality assets, in better locations. And because now I've got that foundation of cash flow properties, I wanted to build a bit more kind of growth properties. So the only thing that stopped me right now is servicing. As I said to you before, I've just recently had a baby boy.
Yeah.
And that means my partner's out of work. I'm looking after him. So we're down to the one income. Coupled with the interest rates skyrocketing, your servicing just goes kaput. So it's a bit of a pause at the moment for the property purchasing.
But looking back with your strategy, I mean, you've bought wisely, and not just in terms of the asset capital growth, but you've also had a real focus on a good solid yield. And just, we haven't gone through every single property in detail, but every one has been, above 5%. And you've got a property here that you've bought the previous, the last one, an 80K purchase with the $550 a week. That's a very, very solid yield. So you've been very, very focused on servicing your debt. Now, we're obviously in an environment now for the last 6-7 months where rates are going up. They're going up consistently and they're going to keep going up from everything that I can see, although we may be getting towards the end of the cycle. So, servicing is getting more of a challenge. But you've bought well. You've thought about the impact of servicing those loans. So you've done well. Tell me what the value, your overall investment property value is. Are you renting at the moment, by the way, in Melbourne, or have you bought to live?
Yeah, we're renting. We're doing the whole rent vesting program. So keeping all the surplus cash to push into assets. But the total portfolio is roughly hovering around the 2.5 million at the moment. So it's quite healthy and 59% LVR. So there's quite a bit of equity there that we have ready to extract when we can get that serviceability again to just keep pushing into better assets, which is exciting for us. So I'm a bit itchy at the moment to wanting to get into it. So, and I agree, I think the rate cycle is probably coming to its end of hikes and we'll see not only a change in sentiment, but probably flattening of the interest rates, which will be able to allow people to jump back into the market. So
I think for investors, it's a real sweet spot. And I don't think it's going to be like a pinpoint sweet spot. I think we're probably looking at 6 months where you've got this general fear around interest rate rises. You've got this constant sort of news of property values dropping. And what that means is, you've got nerves amongst vendors. They can't demand the prices that they previously could. You've got a bit of sort of nervousness. Some people there's always a time when certain people need to sell for one reason or another. So I think there is just this great window at the moment. I think there's always a good time to invest if you've got a long-term strategy. But I think right now we're looking at a really quite exciting point in the market for investors. So you've got your 2.5 million portfolio, you've got your 59% LVR. What is it you're going to look at? How much are you going to extract from your portfolio and what's your next move going to be?
Yeah, I think I'll extract as much as I can, to be honest.
Okay.
I'm quite aggressive in my investing for a purpose, as much as I can calculate risk as well, having all my defenses in place for the property, cash flow buffers, etc. And hence why having such a positive cash flow portfolio was key for me. As we see these interest rates rise over this last year, I've been able to sustain my portfolio. I haven't had any worries with my portfolio, haven't had any cash out of my pocket going to the properties at all. And that's become really pertinent for me, how important it is to be able to hold assets that you can continue to hold. Because I know there's a lot of people out there who are quite negative in their cash flow and every extra cent is out their lifestyle, out their pocket, which again eats into their sustainability of that strategy basically. So yeah, now it's just exciting. I want to try and extract as much as I can and then start buying more assets, continuing this program.
So would you refinance your portfolio to 80%? Are you going to go any higher than that? Are you going to stick to the 80% refinance?
I'd probably stick to the 80%. There's enough in there that I would have plenty to play with. So it'd just be depending on what the next asset is going to be and which property I'm going to refinance it from. Obviously, making sure I can maintain those cash flows, because as you increase the loan from extracting equity, you need to make sure that the rent's still going to somewhat support having that loan.
So are you looking at, for your next purchase, is there a particular state you're looking at, or do you have any, or are you just going to look Australia-wide?
Always Australia-wide, but I'm very bullish on the Adelaide market coming from there. I think there's a lot of hidden potential there, and I know there are some big investors and buyers agents and stuff that are pushing into that market as well. So I'm eager to get myself in there more as well. So there's a few exciting opportunities that there are.
So you've got a bit of a war chest. If you're going to refinance a 2.5 million circa portfolio, you've got potential to draw out several $100,000. What kind of asset are you eyeing up for your next purchase, or is it going to be one asset? You're going to look to buy a couple. Give us a bit of an insight into what your next move is going to be.
Yeah, I think I'm looking to get potentially one more resi.
Okay.
A bit of land closer into a capital city with a bit of more proven growth, kind of a bit of a growth asset. And then I'm actually going to look at potentially commercial property and really increase that cash flow and those yields, because I really need to make sure I can navigate the servicing barriers and servicing walls that, we started to hit with the 7 properties and interest rates, etc., as we spoke of. So making sure we can duck and weave between that is really important. Otherwise, we're just going to get stuck.
That's a really, really good diversification strategy. And, as you say, it's, going into the right commercial property is a fantastic move for cash flow and growth as well. But it's a real bolster when you've got a good residential portfolio to give that additional injection of cash, because, commercial rentals go up and it's usually pre-booked over a 5-year period. So it's very, very sustainable and predictable, revenue. They're very, very hard to break those type of leases. So I think that's an incredible strategy. Give us a time frame on when you're thinking of buying.
I hope within 12 months, well, probably at 12 months realistically, I would hope to be able to purchase another one. So I'd love to buy right now, because I think right now is a really great opportunity, as we've said multiple times. So I think anyone who's looking to invest should be diving in right now. It's the human psychology is so funny. Everyone's been, when we had the heat in after COVID with all the property, everyone was screaming for prices to crash so they could get in. And then we get this dip now, and then no one wants to do it. It's people just kind of follow that crowd, and, you've got to be a bit more contrarian in your investing. So I think now's a great time if you, have the guts to just get in and see that bigger plan for yourself. So I'm a bit itchy that I can't do it myself right now, but yeah, hopefully within 12 months, I could hopefully get another asset. But again, I'm looking for the long term. So if it doesn't happen in 12, when my cash flow allows, I will.
Tim, it's been a pleasure talking to you, and I've just realised how long we've been chatting. But before we go, I'd really like you to just give a bit of guidance to some of the younger people. Oh, you know what? Not necessarily younger people, but people who are listening who are looking to make their first investment. Maybe some of the people who are tuning in who are sort of struggling to get a deposit together, or maybe think it's too big an obstacle. Just give us some guiding signs and a few just gems to take away in terms of getting into that market. And particularly, if you are a younger bloke or a younger girl, 20 years old, what can they do to get themselves started?
Yeah, great question. I think take action. Take action. You got to do something. There's people who are going to do it and people who don't do it. So you got to just make the plunge. Drown out the white noise of the media and all the naysayers, and listen to people who have done it before. Outsource that knowledge. Understand it yourself, but outsource that knowledge. And if you need to use a buyer's agent or whatever it is, do that. If you don't understand it completely yourself, but you just got to do something. And I look at it, most people see it as risky to jump into property, and that's fair. Analyze that risk and then build a defense plan around that to mitigate it, but also analyze the risk of not doing it. That's a big thing for me, particularly as we see younger people now. We're living much longer, and we're not going to be able to have sustainable super. So if we're retiring at 65, 70, we've still got 10, 20, 30, 40 years to live even as we grow older. So you've got to sustain that. So I believe you need to do something. So analyze that risk of not taking action and opportunity costs, basically.
Don't just dream, actually do.
Just do it.
Tim, it's been a real pleasure. Thank you so much for taking time to join us. For everyone else, really appreciate you tuning in. I hope you found this podcast interesting. I've certainly found Tim's story fascinating. I hope you get good value. Look, thanks for tuning in. Do check out all the other podcasts. There are plenty there going back over many, many years. Don't forget to check them out and give us a rating. Really appreciate it. Thanks, guys.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Have you signed up to HR Leader? Go to hrleader.com.au to subscribe. Receive the latest HR and people leadership insights and news.